Lesson 9.2 is all about accounting for merchandise purchases. So in section 9.1, we talked about that we are now adding in a subsidiary ledger for accounts payable. Accounts payable is usually going to be vendors that you purchase merchandise from that you're going to pay at a date later than when you actually receive the merchandise. So doing the transactions for purchasing that merchandise follows right in line with that. So a couple of things. First of all, we don't need to talk about inventory. So inventory is basically merchandise. It's basically just a list of all the assets that are of value for the business. So if you are a shoe company, you're going to have all kinds of different shoes, all different sizes, everything that you have that's in your store that can be sold to other people is called inventory. And in particularly, we call it merchandise inventory if it is stuff that you're going to sell to a customer. The value of that merchandise inventory is going to be in a new account that we haven't used before in the general ledger called merchandise inventory. Merchandise inventory is an asset because if you have a bunch of shoes in your back room and in your store that you're going to sell to your customers, those are something that you own until you sell them. And so they are an asset. Assets have a normal debit balance. So let me talk about inventory a little bit because stores have to keep track of their inventory, and there's a couple different ways that they can do that. The first one is perpetual inventory, and it is where you keep track on a continuous daily basis of increases and decreases in your inventory. Typically, that's going to be done with a computerized system, and usually that's done by scanning the barcodes. And so, in today's world, if you go to Walmart or you go to any grocery store or anywhere like that, that's what they scan. They scan that barcode when you go up to pay for your merchandise. Most businesses anymore have that computerized system that reads that barcode that tells them that you're buying this pair of Nike shoes in size 10 and this color, and then the computer automatically pulls that out of your inventory. And then most businesses will, at some point in time during this year, do a physical inventory. So the first one, a merchandise inventory evaluated at the end of a fiscal period, is called periodic inventory. A lot of businesses will do a periodic inventory monthly, quarterly, yearly. It just kind of depends. And the way they do that is through a physical inventory. And so where they go through the store and physically count everything that you have in the store. So when I used to work at Payless Shoes before I was in teaching and I managed a Payless Shoe store, which doesn't exist anymore, we would about three or four times a year, usually we did it quarterly, so every 3 months, we had to do a physical inventory. And I usually did it on a Sunday evening because that was when the store closed early, and I would have all my employees come in and I would buy them pizza for dinner, and we would do a physical inventory where we went through the store and counted every type of shoe, everything that we had in, put them all in their categories. And then we had to compare that physical inventory to our perpetual inventory to see what was off, and then you have to make it right and everything. That's the way that stores determine what they call pilferage. Pilferage is the term used in business for merchandise that's been stolen out of your business. And then you also compare that to anything damaged merchandise that's been returned or anything like that. So your physical inventory is typically done and compared to your perpetual inventory different times throughout the year, depending on your business. So let's talk about cost of goods sold. So the amount that a business pays for that merchandise is called cost of merchandise. We typically put that into this account called purchases. So if you were to go back and look at that chart of accounts that we looked at in section 9.1 in the video for 9.1, there is a section of the chart of accounts that is called cost of goods sold. And the accounts that are in that section are purchases, purchases discount, and purchases, returns, and allowance. We'll deal with the discount and the returns and allowance in a later chapter. So purchases is increased by a debit and decreased by a credit, and it has a normal debit balance. And the only thing that ever goes into that purchases account is when you purchase merchandise. You go buy supplies, that's not a purchases, that's a debit to supplies. The only thing you ever put in the purchases account is purchases of merchandise that you're going to turn around and sell to your customers. And one of the GAAP rules that goes with that is historical costs, which basically just says that merchandise and other things that you buy are recorded at the time of the purchase for the purchase price. So a purchase order is what is typically used to when you go buy merchandise and you're going to pay for it at a later date. Some places call it a requisition. You're requesting the purchase of merchandise. So like if I want to order supplies for my classroom, I fill out a requisition or purchase order. Some places use the term interchangeably, but technically the requisition is the form that you fill out saying, this is what I want to buy. The purchase order is then what is sent to you when you buy it from the company. But typically that purchase order is going to have the name of the company that is buying the merchandise, who you're buying it from, and it's going to have a purchase order number on it and a date, and it's going to be detailed about everything that you're buying and how many of them you're buying and what is the unit price for the total price and all of that. So in this example, 3 Green bought 50-watt compact fluorescent lamps, 200 of them. Those are light bulbs. And then they bought 100-watt ones, 150 of them. These were the prices for the total. And so this is what they now owe when lighting, $1,082.50. So before we record that transaction, we are going to introduce some new journals to you. So far, we've been using just the general journal. We are now going to start looking at some what we call a special journal. And a special journal is going to be a journal that has special columns on it. The ones we're going to use in this chapter are the purchases journal and the cash payments journal. The purchases journal is for anytime you purchase merchandise. So we looked back here at this purchases. Whenever you do a transaction that's going to be a debit to purchases, it's going to go in the purchases journal. That's the only thing that ever goes in the purchases journal. And then anytime you pay cash, you pay a bill, you pay a vendor, anytime you pay cash, it's going to go in the cash payments journal. We will cover the sales journal and the cash receipts journal in chapter 10. And then we'll also go over then at this point, what type of transactions we have left that will go in the general journal. So we're going to focus on purchases and cash payments in this chapter. So the purchases journal, this is what your purchases journal looks like. Again, only for purchases of merchandise on account. If you purchase merchandise and you pay cash for it, it does not go in this journal. It goes in the cash payments journal. If you're purchasing merchandise on account, so basically an accounts payable, it goes in the purchases journal. And in this journal, we have a date, just like you do in the general journal. You have the account column line, and then you have a column, one column. And at the top of that column, it has account names. It says purchases, debit, accounts payable, credit. So most of these transactions are going to be one-line transactions. You're going to write the name of the vendor that you're buying the merchandise from on the line, the purchase order number, and then the amount goes here. The cool thing about the purchases journal and all the special journals is that they save you a lot of time on your posting. So up to this point, you've been posting 2 items for every transaction, and you still are going to do that. However, You're not going to post each individual purchases to that purchases transaction. At the end of the fiscal period, or at the end of the month, basically, you will add up the total of this column and you will post that to purchases as a debit, the total one time to purchases debit and one time to accounts payable credit. So that will save you a little bit of time. You will still have to post individually to the vendor accounts, but not to the general journal. So it saves some time. So let's talk about a purchase invoice. An invoice used as a source document for recording that purchase on account is called your purchase invoice. Gonna usually be the same thing as that purchase order. You just have to, you use it as an invoice. When you buy something, you usually agree to terms of sale. And the terms of sale are typically going to be, if you're going to get a discount if you pay early, and when the total is due. So like 210 net 30 means you have to pay that invoice. If you pay it within 10 days, you get a 2% discount. If you don't take advantage of that, then you pay the full in 30 days. And we'll talk a little bit more about that at a later date. But that's what terms of sale and due date are all about. So on this example, this is just another picture of an invoice. You start by recording the initials of the employee who's processing the invoice. So you filled out the purchase order, you ordered the stuff from When Lighting. Now, When Lighting is delivering it. You either ordered it online or you went to the store, whatever. They put an invoice in there that says this is what you got. So when you get that, your company then takes that invoice and stamps it. Who received it, what's the date of that it was received, and you give it a document number. Then you go through and you make sure that everything's in the box. So if you ordered this and they deliver it at through the mail or through UPS or some FedEx, someplace like that, you open up your box. You make sure that it says you have 200 of this and 150 of this. You're going to make sure that that's what's in there. And if it is, then you check mark them. If it's not, then you have to make a note that you only got 180 of these or whatever, and you have to call the company and let them know that you did not get what the invoice says it was. And then you review the terms and the date due. So on this particular one, our terms are net 30, which basically just says that the total of this invoice is due in 30 days and that payment is due on December 4th. Because this was on the 11th or the 6th of November. So 30 days after November 6th is December 4th. So net 30. So here's the transaction that you will record. Purchase merchandise on account from When Lighting. Your purchases is going to be debited because purchases goes up with a debit. And accounts payable is going to go up with a credit also because we owe When Lighting now that money. So in your purchases journal, you're going to write the date of the invoice, which was November 6th. You're going to write the name of the vendor, which was When Lighting, the purchase order number, and then the amount. And the amount goes here. When you, at the end, when you post this, you'll post the total of all your purchases together to purchases and to accounts payable. But you will go through and post individually this amount to When Lighting, and that's in another section of the chapter. And that is pretty much how we record in a purchases journal.